All right, whether you should take the standard deduction or itemized deductions, let's not waste any time. Let's jump in it. So the standard deduction for 2024, if you are single, is $14,600. If you are married and filing jointly, then it is $29,200. Now the standard deduction, all it is doing is taking your gross income and reducing it by that standard deduction amount. That means the government's automatically not going to tax you on that amount of money. So if you made $80,000 as a married filing jointly couple and took out $29,200, they're only going to tax you on $50,800. That's what you get with the standard deduction. The only time you are going to take itemized deductions instead of the standard deduction is if you can itemize amounts that are going to get you above the standard deduction. If it does not get you above the standard deduction, don't waste your time, don't itemize. So what can you itemize? I came over here, this is Schedule A from the IRS. This is itemized deductions. This is what you can itemize. Medical and dental expenses. So if you have any medical or dental expenses, this is where you're going to enter it into. TurboTax is awesome. If you want to see a video on how I explain whether or not to choose a CPA versus TurboTax, I'll put a link in the description. But TurboTax is going to ask you these questions. They're going to list out all of these things. So if you have medical and dental expenses, you can put it in here. You do have to do a calculation. It can only be 7.5% of your adjusted gross income. So you're going to pull some of that in. But you're going to list all of the medical and dental expenses that you have. State and local taxes, this one as well. So this can be state income tax. It can be sales tax. You're going to have real estate tax. You have personal property tax. You're going to enter all of those things in. Now there is a limit of $10,000. So you're going to enter in $10,000 and you're going to take whichever is lower. So if $10,000 is lower, then you put in $10,000. So you're going to add that in. Interest that you paid. So if you have home mortgage interest that you paid, then you're going to put that in as well. And so you're going to add up all the interest that you paid, any gifts to charity. Now, any gift over $250, just to make sure that you're on the safe side, you need to have a receipt from whatever charity you gave it to. So you're going to put all your gifts to charity, put that in here, and then any casualty or theft loss. So, if you had a disaster, if there was a tornado in your area, or if you're a fire, any of those things, you can put that in there and enter in that loss. And then you're going to add up all of those things, and that's going to get you to your total itemized deductions. If your total down here is not higher than this standard deduction amount that I've already explained, then you do not want to itemize. If it is higher, then itemize, claim the itemized deductions, reduce your adjusted gross income as far down as you possibly can to get to your taxable income, because we want to save as much money as possible on our taxes. So if itemizing does that for you, then you should absolutely itemize. Now, if you have any questions as we are nearing tax season, please hit me up in the comment section. I respond to every single comment. Thanks for watching, and we'll catch you guys next time.